Hey everyone, today I wanted to finally revisit the series on disciplined trading, and in this episode I want to talk about developing a trade checklist, why it's important, and where we can go from there. So as far as why create a checklist in the first place, from my last video I really tried to emphasize some of the common fears of trading, namely many of them being losing, being wrong, fear of missing out, and fear of letting a win turn into a loss. Those seem to be some pretty common fears discussed in Trading in the Zone by Mark Douglas, and some that I could relate to in my own trading. And I found that the best way to combat those fears is to not let emotions dictate my trade. So in other words, creating a strict and rule-based strategy that will greatly eliminate the chance of you making, impulsive trading decisions that aren't a part of your plan. And this process of following a proven system with strict rules, day after day, week after week, will eventually force you to develop the habits of a consistently successful and disciplined trader. And once you're able to objectively define your edge, then you can backtest it and collect data to see if you can differentiate what makes a high quality setup versus a low quality setup, and ultimately just evaluate its overall effectiveness and expectancy over a large number of trades. So I'm going to be using my inducement setup that I've been talking about for a while now. It is a scalping strategy. I use a 15-second chart, and as you may already know, my core criteria is to see a liquidity sweep, volume spike, supporting market structure, and a close back through a key level. And I've said this before, I know ICT does not like to use volume at all, but in my mind it kind of helps confirm my bias when I'm watching key levels to see if liquidity is taken. So when price trades through them and there's a large volume spike, it's kind of just a visual confirmation to me that liquidity was resting below or above certain pivots. And in my own experience of backtesting this, some things that I've kind of used to help refine which setups I take is that I look for a volume spike where the volume is 1.5 times greater than the average, which I just use a 100 SMA. And once price takes out that level of interest that I'm watching, I want it to close back through it within 2 minutes. And in that sequence, I want to see 2+ consecutive candle closes through the key level. And largely that's just because I'm on such a low time frame chart that I just want to see some continued aggression versus just one candle close back in that direction. So zooming into the actual setup, we can see that we have supporting market structure. So we take out these previous highs pretty aggressively, make a local low, trade above it. And now once this high forms, that's when I'm watching these levels to see if price trades below them, how does it react? So price takes out this key level on volume, which is important for me. So it trades roughly probably like 2.5 times the average volume right here. And now if I zoom into this consolidation right here, this is the level of interest that I'm watching right here. And I see price has 3 consecutive up close candles to get back over that pivot. So now that is my criteria to get long. So now that we have a checklist, we can actually start backtesting and seeing if it's a viable strategy. And while backtesting, we should also be collecting various data so we can further kind of differentiate what makes a setup good or bad, high quality or low quality. And that's what I was talking about in the beginning, where you just want to have a couple of key factors that you're tracking in all your trades to see if you can determine anything that just helps refine your edge a little more. So some potential correlations we can make is that we could, for instance, track the quantity of the volume spike. So obviously the criteria for me is a 1.5 times volume spike above the average. But if we're collecting this data over dozens of trades or hundreds, then we can look at that data and see, do larger volume spikes lead to a higher probability of success or something like that? And the same thing for all other criteria. Do successful trades often close back through this key level quicker or slower? Should we be looking for more than 2 consecutive closes through the inducement level? And maybe also look at how far did the trade actually go before stopping out? And this is a question I want to emphasize is, should we implement a trailing stop or scale partials along the way? So the reason I want to focus on that is because you should decide on your, preferred trade management system before you start the backtest. Because I'm sure, as we've all experienced, we'll often fall into a trap of, once we go on a losing streak or we start losing trust in our system, then we start to often tweak the variables to see if we can do any better. But the problem is, if you've done all this back testing with a fixed stop loss, and then somewhere down the line you change your trading to utilize only a trailing stop loss, then you should expect to see much different results because that's not what you accounted for in your testing. And maybe it'll be better than you expected, but maybe it'll be worse. But the point is that you don't know if you haven't tested for it. So for example, this is the same chart we've been looking at all video. If I took this long right here and I was risking this low and aiming for this high, then if I use a fixed stop loss right under this low, I would have never gotten stopped out and I would have reached the target. But if I decided to, for some reason, use a trailing stop and it wasn't part of my system, I could have maybe entered here, and as soon as, you see this price leg that almost hits target but doesn't quite get there, I might decide to push my stops to break even. And it just so happens that price comes back down to that level before continuing higher. So if I did use a trailing stop loss and push it to right around my entry, there's a chance I would have gotten stopped out and not realized the full potential of the trade. And for me, I think the ideal method of stop loss really comes down to personal preference, but mostly due to psychological reasons. So if I have a system where, I'm winning maybe 30% of my trades, but I'm using a fixed stop loss, that means 70% of the time I am losing money on a trade. And so after a while, that might just get mentally tiring. But if you were to at least push your stops to break even once your trades hit 1R or something like that, then you now have a distribution where maybe 30% of your trades are failed, maybe 30% are winners, and then the remaining 40% are just stopped out of break even. So mentally, it might just be a more tolerable thing for you to include in your system. And it's important to also be aware of the numbers of how this affects your trading as well. So if we're looking at fixed versus trailing stops and the results over 100 trades using 2 to 1R, in a scenario when you're using a fixed stop loss, you only have 2 possible outcomes. You either lose 1R or you gain 2R. And if you had a 50% win rate, then you would have 50 wins plus 50 losses. So you would have 100R minus 50R, which would result in plus 50R expectancy over 100 trades. But if you instead used a trailing stop loss, if we're directly comparing all the same setups and you're using a trailing stop loss and you sometimes get stopped out of break even, that means you will have less occurrences of stopping out of position fully and less occurrences of seeing your full target. So now your possibilities are losing 1R, going break even, or gaining 2R. And if you push your stops to just above break even so that all your break even trades are, you're just gaining a couple bucks each time, then let's say you have a 70% win rate, but half of them stop out at break even. So now that 70% win rate, although it sounds good on paper, splits into 35% that stop out at break even and 35% that hit the target. So 35 winners at 2 to 1R is 70R, 35 break even obviously gains nothing, and 30 losses is minus 30R. So you end up with plus 40R despite the higher win rate versus the 50R from the 50% win rate with a fixed stop loss. Now you could also consider trailing stops and scaling out with partials. So similar to the last scenario, where here is where you would have pushed your stops to break even to trail your stops. So now if we're trailing and trying to scale, let's assume that once we get to 1R, that's when we're going to take off 1/3 of our position and push stops to break even. So we could either lose the trade immediately for minus 1R, we could scale off 1/3 at 1R, or we could scale 1R for 1/3 of our position and the remaining 2/3 sees our ultimate target. So the possibilities with that are minus 1R, plus 1/3R, or plus 5/3R. And again, with something like a 70% win rate, for simplicity's sake, let's just say we have a 70% win rate again and half stop out at break even after scaling at 1R. So now that 70% obviously splits into 35 and 35, where half of those stop out at break even after scaling and 35% hit the target after scaling. So you have 35 wins at 5/3R, 35 that stop out at break even, but in each case you took off 1/3 of the position at 1R, and then 30 losses. So all those combined would again result in plus 40R. And again, all these win rates and everything are just hypothetical. I'm just trying to demonstrate the differences between different risk management methods. For the sake of this series, I'll probably be using a fixed stop loss just to make the backtesting a little easier. But I'm just going to emphasize again that it's important to stick to one risk management system, and it's just as important as sticking to the same checklist every time. Your risk management system should be a part of that overall trade plan. So I'm going to stop this episode here for now so I can go grab some backtesting data, try to draw some high and low probability correlations from all that data, and from there we can start to filter out, quote unquote bad setups and just evaluate the effectiveness of the edge overall. I'm not quite sure how I'm going to gather all the data in the sense that, I might make like a Notion template or something that's publicly available with pictures for all the setups. I'll try to make it as easy as possible to be, transparent and just share all the backtesting data so that we're not scrolling through 100 different charts in the next episode. But anyway, that's all I have for now, and I'll see you in the next one.